The committee will come to order without objection. The chair is authorized to declare a recess of the committee at any time without objection. All members shall have 5 legislative days within which to submit additional materials to the chair for inclusion in the record. Chair now yields to himself for 5 minutes for an opening statement. We have 2 bills that are before us today, and the underlying matters are well vetted before this committee. One bill would terminate the orderly liquidation authority of the Dodd-Frank Act, a bill authored by the gentleman from Georgia, Mr. Westmoreland. The other would ensure that the CFPB is placed on budget, a bill by the gentleman from Kentucky, Mr. Barr. With respect to the OLA bill, I would remind all members that last evening they had an opportunity, as just about every member did, to vote for a bankruptcy bill for large, complex financial institutions, a bipartisan bill, not within this committee's jurisdiction, but within the jurisdiction of the Judiciary Committee. It was passed overwhelmingly last night, and I hope that it will enjoy swift passage through the legislative process and be signed by the President into law. It is important because what this bill, the gentleman from Georgia represents, is an opportunity to once again reaffirm when it comes to the resolution of these large, complex financial institutions, should we have bailouts or should we have bankruptcy? I think most people, particularly on the Republican side of the aisle, believe there should be bankruptcy. No sweetheart deals, no more AIG deals, where foreign banks get, foreign creditors get 100 cents on the dollar, that the bankruptcy process is far superior. There is no one financial institution that should be deemed too big to fail and others too small to matter. And it was an important bill that was passed last night, and this is a complement to it, to ensure that there is an improved bankruptcy process for these institutions, but it needs to be a bankruptcy process, and it needs to be done without taxpayer funds. Now, for those who are saying that somehow the taxpayers will be compensated for their loss, we heard the same things regarding the National Flood Insurance Program. We've heard the same thing with respect to the FHA bailout. We've heard the same thing with respect to PBGC. We've heard these promises before that taxpayer funds are not at risk. Lo and behold, it proves that they are. Again, it's a very simple matter. For large, complex financial institutions, do you want bankruptcy? Do you want bailout? With respect to the CFPB, we will continue to debate the activities of this particular rogue agency, but there's a very important principle involved, regardless of whether we're dealing with the CFPB or any other government agency, and that is Congress's Article I authority to make laws, Congress's Article I authority to exercise the power of the purse. Every government agency ought to be accountable to the elected representatives of we the people, and CFPB should not be an exception to that rule. We have the Pentagon, which is on budget. We have the Justice Department, which is on budget. There's certainly no greater duty we have than to provide for the common defense, and we do not let the Pentagon write their own budget. We should not let the CFPB write their own budget. It is a base matter of congressional oversight and of Article I authority. And in this particular case, this is an agency that is so deserved of oversight, and merely attending a hearing and sitting in a witness chair is no substitute for actually having the agency on budget. And I would remind my friends on the other side of the aisle that not only are they on the other side of the aisle, at some point the shoe's going to be on the other foot. At some point the White House will change hands. At some point the Congress will change hands. Do they want a CFPB head who might request $8.47 as the entire budget for the CFPB and have absolutely no voice in that matter? I would have my friends on the other side of the aisle contemplate that. I'm happy to say also, as I look at the national debt clock spinning out of control, that both of these bills, according to the Congressional Budget Office, that I have been known to quibble with on occasion, score these as both direct savings, not unimportant as we continue to see, again, our unsustainable national debt roll out of control. I look forward to passing these bills through this markup today. I commend the gentleman from Georgia and the gentleman from Kentucky for their leadership. I yield back and now recognize the ranking member for an opening statement.
Thank you very much, Mr. Chairman, for holding this markup this morning. Today, we will consider two measures that strike at the very foundation of the reforms we established in the wake of the most devastating economic crisis since the Great Depression. The first bill, H.R. 1486, would essentially repeal the Consumer Financial Protection Bureau. The second bill, H.R. 4894, would strike the mechanism we created in the Wall Street Reform Act to safely unwind large financial firms whose unexpected failure would otherwise trigger financial panic across our economy. Both of these bills, if enacted, would take our financial system back to September of 2008, when regulators did not have the tools to protect consumers or the broader economy from financial sector ruin. It would take us back to a time when we were hemorrhaging nearly 800,000 jobs a month, household wealth dropped by $13 trillion, and millions of our fellow Americans were facing foreclosure, eviction, and potential homelessness. Democrats on this committee, who still freshly remember the devastation of the crisis, will stand today in opposition to these measures. The first measure, 1486, would repeal the independent funding of the CFPB. The majority on this committee will claim that this produces $6 billion in savings. However, it is important to remember that this can only be true if the Congress never appropriates any funding for the Bureau moving forward. So the Republicans' clear intention for this bill is to repeal the very existence of the Bureau. Sadly, this latest step is fully consistent with the majority's efforts since 2008. Republicans opposed the creation of the CFPB, opposed independently funding it as other banking regulators are funded, opposed its nimble and responsive structure, and oppose every single measure the Bureau has taken to protect our consumers. Indeed, whether it is protecting service members from financial predation, regarding students from fraudulent for-profit schools, or establishing clear rules of the road for payday loans, the Republicans stand in lockstep opposition. This is despite the Bureau's commendable record of returning over $11 billion to more than 25 million consumers. The second measure we will consider today is similarly dangerous. This bill, H.R. 4894, will repeal Dodd-Frank's mechanism for resolving a teetering financial institution whose failure would otherwise send panic through our economy. Again, this bill uses budget gimmicks to generate illusory savings while failing to recognize that the orderly liquidation authority is paid for by an assessment on our largest financial firms. What's worse is that the Republicans are pursuing this measure without offering any alternative on too big to fail. Beyond their partisan talking points, the majority on this committee has advanced no credible mechanism by which we could resolve our largest banks and non-bank institutions. Every credible expert on this topic has said that if you want to demand that financial institutions can go through ordinary bankruptcy, you must take proactive steps through Dodd-Frank, living will process, or otherwise to simplify their structures and limit their interconnectedness. In short, the bills we will consider today are tremendously harmful for our nation's economy and will make consumers and investors less safe from financial ruin. The budget savings the bill purport to achieve are nothing more than gimmicks. Unfortunately, these measures will only serve to further the devastating cuts to social safety, and safety net programs like homelessness assistance, public housing, community development block grants, and our House Republican colleagues have consistently, they have advanced consistently since 2011. So I thank you, and I yield back the balance of my time.
Now pursuant to notice, I call up H.R. 1486. The clerk will report the bill which was distributed in advance.
H.R. 1486 to amend the Consumer Financial Protection Act of 2010 to bring the Bureau of Consumer
Without objection, the
Financial...
bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Kentucky, Mr. Barr, to offer an amendment in the nature of a substitute. Does the gentleman have an amendment at the desk?
Yes.
I am been informed that copies of the amendment have already been distributed and are on the dais. The clerk will report.
Amendment in the nature of substitute offered by Mr. Barr. Section 1, short title. This act might be cited as the Taking Account of Bureaucrats Spending Act of 2016.
Without objection, the amendment is considered read and will serve as base text for purposes of amendment. The gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. H.R. 1486, the Taking Account of Bureaucrats Spending Act, or TABS Act, is a very simple piece of legislation. All the bill does is reaffirm Congress's power of the purse in relation to the Consumer Financial Protection Bureau, which currently draws its funding directly from the Federal Reserve by subjecting it to the appropriations process. My amendment in the nature of a substitute clarifies that the bill level funds the Bureau for fiscal year 2017 with an authorization of $485.1 million. That funding level is equivalent to the sum requested by Director Cordray for fiscal year 2015, the most recent complete full year of funding we can refer to for the Bureau. According to the statute, that level was determined by the Director to be, quote, reasonably necessary to carry out the authorities of the Bureau, unquote. H.R. 1486 is about transparency, oversight, and accountability. When I'm home in Kentucky's 6th Congressional District, I frequently hear concerns about out-of-control Washington bureaucrats. Well, the Bureau could be the poster child for out of control. The Bureau drafts rules at will without public comment. It uses policy guidance as a binding tool of law. It engages in ad hoc enforcement actions based on rules yet to be finalized, or sometimes even worse, without clear legal authority at all. And in industries it is expressly forbidden by law from regulating. It shakes down American companies for millions of dollars and the issuance of a self-serving press release. There may be good-natured disagreement about the nature and scope of the Bureau's mission, but surely we can agree that the Bureau, particularly with regard to its spending, should be accountable to someone. In testimony before this committee, both Director Cordray and Federal Reserve Chair Janet Yellen have repeatedly attested to the fact that the Bureau's budget is not subject to review or approval in whole or in part by the Fed. There is no sign-off. There is no oversight by anyone. We know from testimony and by statutory design the Bureau is not subject to accountability to the American people through the representatives in Congress. That's the statutory design. But we would hope that the Bureau would at least be accountable to the source of its funding. And at a time of unprecedented national debt of more than $19 trillion, the lack of oversight of the Bureau's budget is more than just a failing of accountability. It is offensive. Present and future taxpayers are on the hook to repay that debt, and in the meantime, the Bureau has seen fit to waste money at every turn. We are all familiar with the fact that the Bureau spent more than $215 million renovating a building it does not even own, and that itself is worth only $153 million. I'm sure taxpayers will be comforted that the Bureau employees are able to enjoy an indoor waterfall, a sculpture garden, and rooftop playground that cost more per foot to construct than did the Bellagio Las Vegas luxury hotel and casino. The Bureau pays many of its employees more than members of Congress, and in some cases a lot more. Though salaries are nominally controlled by language in Dodd-Frank, this committee has heard testimony that employees are frequently made whole through incentives and bonuses to achieve salaries well above GS 15. A review by the GAO has found serious internal accounting deficiencies in the Bureau's own implementation of its budget. And finally, the Bureau also has a far higher per capita level of complaints concerning discrimination than other federal financial regulators. One of this agency's objectives is to promote financial education, which is certainly ironic given its failure to control costs. When asked about these matters by members of this committee, Director Cordray has repeatedly refused to answer questions about the Bureau's business, or worse, responded with condescension, knowing that the Bureau may act with impunity since its funding and bad behavior are beyond the reach of Congress or anyone else for that matter. This demonstrates a clear failing of accountability and transparency. The existing structure threatens good governance in a way that should give pause to members of both parties. And there will one day be a new party in the White House and a new director at the Bureau. This is not and should not be a partisan issue. It is an issue of importance related to the institutional integrity of the Congress and the willingness of members of Congress of both parties to defend Congress, this institution, and its constitutional Article I powers against an executive branch that has encroached upon the legislative function. As James Madison wrote in Federalist Paper number 58, the power of the purse may in fact be regarded as the most complete and effectual weapon with which any constitution can arm the immediate representatives of the people for obtaining a redress of every grievance and for carrying into effect every just and salutary measure. I urge my colleagues to reaffirm this power on behalf of our constituents, the American people, over this Bureau, and I call for your support in passing H.R. 1486 as amended. I yield back.
Time of the gentleman has expired. For what purpose does the ranking member seek recognition?
Move to strike the last reading.
Gentlelady is recognized for 5 minutes.
Mr. Chairman, as you know, many of our banking regulators are not funded through the appropriations process. This includes the Federal Reserve System, Federal Deposit Insurance Corporation, the National Credit Union Administration, the Office of the Comptroller of the Currency, and the Federal Housing Finance Agency. There are several good reasons for this. First of all, it allows the regulators to be independent voices so they can take on large financial interests without being handicapped by billion-dollar lobbying efforts. Furthermore, these agencies need to be up and running for our economy to function and cannot be subject to the whims of a Congress that can't manage to pass a budget or threatens to shut down government operations when it can't get bills passed through regular order. Finally, these agencies are funded in a way that makes sure the financial burden of regulating their activity falls on banks and not the taxpayers. While the CFPB is funded independently, like many other independent regulators, it has much tighter safeguards on its management and supervision than its fellow banking agencies. The CFPB is also the only regulator, banking or otherwise, whose budget is subject to a statutory cap. The CFPB is also subject to Small Business Regulatory Enforcement Fairness Act panels, which require it to make special considerations for small businesses in its rulemakings, unlike any other banking regulator. The Financial Stability Oversight Council can, by vote, veto CFPB rules. No other agency is subject to such oversight by other independent regulatory bodies. The CFPB is also audited annually by the GAO, and, of course, has been under intense congressional scrutiny since it opened its doors. CFPB senior officials have appeared before Congress more than 50 times since the agency opened its doors, have been responsive to Republican requests to review tens of thousands of pages of agency memos and internal communications, and are being hauled up to the Hill this week to be deposed by the majority. As far as I know, this is the first time our committee has taken such drastic action since the Whitewater investigations. Few agencies in Washington are as accountable and responsible as the CFPB. While my friends on the other side of the aisle say they want accountability and oversight, their budget talking points tell a different story. The cost savings that Republicans claim will result from putting the CFPB on appropriations can only be realized if Congress ceases to fund the agency starting in 2018. That means in 2 years, consumers will be on their own with no watchdog to protect them. The intent is clear. The party that did not support the creation of this agency, who blocked its director from being considered in the Senate, who has obstructed every rulemaking and enforcement action, really just wants to destroy this agency. Democrats are not going to let that happen. Mr. Chairman and members, as I have recounted in this testimony. You've done everything you could possibly do to destroy the Consumer Financial Protection Bureau. You seem to have forgotten completely that the oversight agencies responsible for consumer protection really did not pay any attention to our consumers prior to the reform that we were able to get signed into law, Dodd-Frank reform. And finally, we have a watchdog. We have someone who cares about the consumers. We have an agency that consumers are calling into. We have demonstrated success of this agency. They have returned all of this money to those who have been harmed. What more do you want from the CFPB except total destruction? Democrats are not about to allow that. And even if you were able to get through the House and the Senate on a bill like this, it would be vetoed by the president anyway. So I don't know why you persist in trying to destroy the Consumer Financial Protection Bureau. Mr. Cordray and the Bureau have suffered all kinds of insults. They have suffered all kinds of intimidation from you. What more do you want? The Consumer Financial Protection Bureau is here to stay. And I believe that whether we're talking about this president or another president, be it Democrat or Republican, they're not going to attack this Bureau in the way that you're doing now. They're not going to destroy it. The public won't allow it. So I would hope that you would cease and desist from these kinds of bills and these kinds of attempts. It simply will not work. I yield back the balance of my time.
Gentlelady's time has expired. For what purpose does the gentleman from Texas seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman, and I want to rise in support of H.R. 1486, the gentleman, Mr. Barr's bill. It's a good bill. I'm proud to be a co-sponsor. One of the things I'd like to start my comments with is this. Is there anybody, any member here that is against consumer protection? Would you please raise your hand if you're against consumer protection? So I think one of the things we can agree to then is that we are all for consumer protection in this room. I don't think there's any member of Congress that's against consumer protection. I think what we're talking about here, though, is the process on how to best protect the consumer. And protecting the consumer isn't about necessarily always taking away some of the consumer's choices, but making sure that the choices that the consumers have are good choices. Now, what all of this debate is about is the fact that when we had the collapse in our financial markets, we didn't do our homework. We didn't go back and do an autopsy on how we actually got into that situation. I think the thing that what Republicans are saying is you have to go back and look at a little bit of history here. And here's the history. We were all sitting around here, and we had all of these regulators, and they were supposed to be looking over these entities for safety and soundness. We have a Federal Reserve Chairman, a Treasury Secretary, all of these people, big regulatory structure. They're in these entities, some of them on a daily basis. And now what we're told is the best process is to let those same people have all of these secret meetings, come up with these different scenarios that are not transparent, and that the results of which are not transparent, and they're expecting the United States Congress to say, I guess y'all are doing a good job. What I think the people in the 19th Congressional District of Texas sent Randy Nagelbauer to Congress to do is to make sure that the people that are supposed to be looking over these entities are doing a good job, and that there is market transparency out there so that that little investor or the customers know that the institutions that they are dealing with are operating in a safe and sound way and in a fair way. But we cannot do that if we have no oversight capability. And so what Mr. Barr's bill does, something that I support, it just says, you know what, you have a pretty big budget over there. Hey, and you have a pretty important task of taking care of consumers and making sure that they have good choices and that they're being treated fairly. And so I would just commend Mr. Barr and his bill and say this is a first step. There's a lot of other steps too. If this is important, and what I just saw by the fact that nobody is against consumer protection, if this is an important subject, why in the world would we be against having a transparent process? Doesn't the consumer benefit when there's oversight? I would think yes. Does the consumer benefit when there's transparency? I would say the answer to that is yes as well. So, Mr. Chairman, I would like to just give my support for this bill and encourage my colleagues to do the same.
Would you yield to the
I
chairman?
would yield to the chairman.
I thank the gentleman for yielding. I thank him for his long, storied leadership on this issue. I must admit I heard at least one thing from the ranking member that has disturbed me, and I think that she said that CFPB cannot be subject to the whims of Congress. And I find that to be a rather chilling statement. What is it that why did people run for this office in the first place? Why is there an Article 1 of the Constitution? We are the elected representatives of we the people. Why do we wish to continue to export our legislative powers over to some other agency of government? Why do we wish to outsource not only our legislative powers, outsource the power of the purse? That should be a rare exception, a very rare exception indeed. And so I thank the gentleman from Kentucky for his leadership, and from his Madison quote, don't have the facility for quotes that he does, but Madison in Federalist 47 said, the combination of all powers, legislative, judicial, and executive, in the same hands are the very definition of tyranny. Why would we want to support tyranny? Let us put this on budget. It is one simple matter, and that is who should control the budget of the CFPB, themselves or the elected representatives of we the people. I thank the gentleman for yielding who seeks recognition. For what purpose does the gentleman from Texas seek recognition?
Chairman, I move to strike the last word.
The gentleman is recognized for 5 minutes.
I rise in opposition to H.R. 1486. Under the guise of accountability, my Republican colleagues seek to object the Consumer Financial Protection Bureau to the regular appropriations process, despite no other financial regulator being subjected to the same. Our financial regulators, including the OCC, including the SEC and the CFTC and the FDIC and the Federal Reserve, have all been structured by Congress as independent agencies specifically to insulate the regulatory and supervisory mission to oversee the safety and soundness of the American financial system from partisan politics. I'd like to remind my colleagues of the slippery slope we engage in when we try to hamstring our financial regulators with constant political attacks. With respect to the 2008 financial crisis, while the regulators did not cause the crisis, they certainly did not act to prevent it. The regulators were not merely asleep at the wheel. They were badgered into a state of timidity and regulatory capture by unrelenting political pressure from both sides of the aisle, from Congress to the presidency to the Federal Reserve. According to my Republican colleagues, the CFPB is the most unaccountable and unconstitutional government agency ever created, and Congress must step in to bring this renegade agency under control. Well, let me say this. This is simply not true. The CFPB is quite accountable. The director is presidentially appointed, Senate confirmed, and can be removed by the president for cause. In a twist of irony, my Republican colleagues are simultaneously seeking to decrease accountability at the CFPB by removing the director and replacing him with a commission that would be more independent and less accountable to Congress and to the president. In addition, the director must testify before Congress biannually. The CFPB budget is statutorily capped. The CFPB rules are subject to the Small Business Regulatory Enforcement Act. This bureau is subject to the Regulatory Flexibility Act, the Paperwork Reduction Act, the Congressional Review Act, and the Administrative Procedure Act. The Bureau's operations are subject to private sector independent audit as well as GAO audit, and this Bureau is monitored by the IG of the Federal Reserve and subject to general GAO oversight. The sad truth is that my Republican colleagues simply do not like the Bureau and would like to dismantle it piece by piece. Since the CFPB was created, Republicans have waged an unrelenting campaign to eliminate the agency and question every action the Bureau has undertaken to protect consumers. In the aftermath of this 2008 crisis, we learned that consumer financial products left unregulated can spread debt throughout our economy like wildfire, wreaking havoc on hardworking families and morphing into dangerous financial weapons of mass destruction. We should be working to prevent another catastrophe, not trying to hamstring the federal agency dedicated to protecting consumers. Mr. Chairman, I yield the balance of my time to the ranking member, Maxine Waters.
Thank you very much, Mr. Chairman. In the few seconds that are left, I am very interested in the question or the statement that was made by Mr. Nagabagar, who said we're all supportive of consumer protection. Well, I don't have the quote of anybody famous, but I think it was many of our elders who have said for years, the proof of the pudding is in the eating. And so it's not what you say, it's what you do. And you demonstrate whether or not you are in support of consumer protection by the way that you deal with their funding or lack of funding and other issues that would determine whether or not they can be successful in doing the job that they're mandated to do. So, Mr. Nagabaga, I appreciate what you have said, but I don't understand why you would throw them into the appropriations process and threaten their ability to do the job that we intended for them to do. I use
Time.
Yield back the balance of my
Time of the gentleman has expired. For what purpose does the gentleman from Wisconsin seek recognition?
Move to strike the last word, Mr. Chairman.
Gentleman's recognized for 5 minutes.
Thank you, Mr. Chairman. I just want to be clear. I think there's a lot of red herrings or straw men that are being put up by my friends across the aisle. Mr. Barr's very excellent bill is not about dismantling the CFPB, not destroying the CFPB. It's about putting the CFPB on budget. Very simple. And I think Mr. Barr's bill goes to the heartbeat of the balance of power that our founders envisioned, making sure that the agency that protects consumers is responsive to this institution. If the CFPB works for the people, why would they be afraid of the people's house? If they're doing the good work of the American people and helping the American people out and protecting the American people, they should have no fear that they get their appropriations and their money from the elected representatives of the people. Now, if they're doing things that the people may not like or may harm the people, then you might see why they would advocate that you're taken away from the people's house and getting your funding from some other source that's not responsive to the people. I mean, I think a good example is if you answer to the American people, why does the CFPB take personal identifiable information from consumers without asking for the consumer's permission or consent? They don't, because the consumer would say, listen, no, I'm okay giving my credit card company, my bank, my personal information, but I don't want my government to have it. We tried that with the NSA. We didn't like it. I don't like the CFPB collecting my information. They don't ask consumers because consumers would say, no, we don't want you to have our information. I too, like the chairman, was troubled by my good friend, Ms. Waters, who I count her as a friend of mine, but when she said that the CFPB should not be subject to the whims of Congress, I mean, that is a stark difference of opinion about the role of our institution. Maybe there's a viewpoint that the CFPB shouldn't be responsive to the whims of Congress, but nor should the EPA, the DOJ, the Department of Defense, that we just have these decisions made by an all-powerful executive. I mean, I think there's a reason why the Capitol is up on a hill and the White House isn't on a hill. The founders wanted the people's house on the hill looking down on the executive. They didn't like kings. They were concerned about executive power. We're up on the hill. I think there's also no wonder, as I watch what happens on my television at night, that one of the individuals who probably gets some of the biggest crowds, energizes a lot of youth, that he is a devout socialist, communist. He actually went on vacation to the Soviet Union, where they don't have checks and balances. They didn't have checks and balances under Soviet power. And I look at what this institution at the CFPB does in its unresponsive nature to the Congress. You can come and give speeches. You can come and take questions and not answer those questions. But does that mean that you're accountable? Does that mean if an American citizen has a grievance with the CFPB, how do they petition the CFPB to change that rule? Where do they go? Who listens to them? If they come and see any of us, and I know they do, they come and see all of us about some of the problems they have with the CFPB, what do? You write a letter. We've been relegated to writing letters to the CFPB or making a phone call saying, please, the rule that you're implementing is actually not helping consumers, you're hurting consumers. Please don't do it. You don't have any power. You don't have any control. And that we slow clap the fact that we've given the power to the executive and taken it away from us, and you think that's a good thing? It's a horrible thing. That's not the way our government should work, is supposed to work. And you know what? I'm all about consumer protection. My constituents wouldn't stand for a representative who didn't advocate for their protection. But to not empower me in Wisconsin or Tammy Baldwin or Ron Johnson to have a say in the rules that come out of the CFPB is asinine. We should have a say. That's our role. That's why we were elected. And the fact that Mr. Barr's bill is undermining the CFPB is absolutely false. What he's doing is empowering the Congress to have a say in the role that the CFPB takes in our lives. With that, my time has expired. I yield back, Mr. Chairman.
Time of the gentleman has expired. Who seeks recognition? For what purpose does the gentleman from Colorado seek recognition?
Move to strike the last
Gentleman
word.
is recognized for 5 minutes.
And the rhetoric continues to rise here. And clearly, this is an issue about funding the Consumer Protection Bureau. It has nothing to do with whether or not we can object to a rule, object to an action taken. We do that. We've done that. So to take it to that point, I think, is a big exaggeration and isn't helpful to the debate that we have today. And the question, and Mr. Hinojosa, I think, was just perfect in his description, the opposition to this agency has been from the beginning, and it's every day. It's not an opposition to consumer protection. I'd agree with the gentleman from Texas about that, but it certainly is an opposition to this agency. And I appreciated Mr. Barr's quote from Madison, but it kind of reminded me of a different quote, which is, and paraphrasing it, the power to refuse funding is the power to destroy. And that's the purpose here. This isn't questioning the rules. We can override the rules. We can add oversight to these rules. But it's opposition to the agency itself. And I think on both sides of the aisle, when you're back home, people are wary of the connection from Wall Street and financial industry through Congress to the laws that are passed. And we all are dealing with that on both sides of the aisle. And we have to recognize that. And this is a place where a decision was made to at least limit the potential of partisan politics on things that might benefit or harm consumers. And so I appreciate the gentleman from Tennessee or Kentucky. Where the heck are you? Kentucky, sorry about that. I appreciate your approach here, but it really is the power to just eliminate the organization. And I think that that is wrong, and I'm going to oppose the gentleman's bill.
Would the gentleman yield?
Yes, sir.
I appreciate the gentleman. You know, I hope that everybody has read Mr. Barr's bill, because Mr. Barr's bill does not cut funding in CFPB. It actually allows it to be funded at last year's level. And what Mr. Barr's bill allows for is the gentleman saying this is about the funding level. What it does allow the CFPB to do, and I know that many of you have a very fond feeling about the great job that you think that they're doing at the CFPB, it just says to the CFPB that they get to come over and tell the United States Congress what a great job they're doing and how they could do a better job maybe if they had
Reclaiming
more
my
resources.
time
But if they're not doing a good
reclaiming my
job,
Time belongs to the gentleman from Colorado.
Texas. Appreciate the gentleman's comments. But this goes deeper than that, I would say to my friend from Texas. This goes to the ability to eliminate funding, period. Now, it may be that they can come over here and say, we wanted, you know, we've done great things, we're entitled to that funding. But it may be in opposition to the partisan nature of the politics that we face, either through our contributors or through at home. And this organization, as Mr. Hinojosa said, needs to remain independent in its funding and its approach. We can and we still have the right to override or change any rule that they promulgate. And that's the point here. Not to eliminate, which is the power of the purse. And I would just say, if my friends on the Republican side of the aisle didn't go after this agency every chance they get, maybe I would have more sympathy to this legislation. But I don't. And again, urge that its defeat. And I appreciate the gentleman from Kentucky bringing this bill, but I oppose it.
would the gentleman yield?
How much time do I have? No, I'm not going. Yes, I'll yield to my friend from Texas.
Well, I've read Mr. Barr's bill. I do not see the word eliminate anywhere in this
All right,
bill.
reclaiming my time.
Yeah.
I appreciate the gentleman's point. This allows for us to do that at some point in the future, and I would now yield back my time to
Will the gentleman-
the other gentleman from Texas, our chair.
The gentleman has yielded his time back.
gentleman
For
yield
what
the-
purpose does the gentleman from New Jersey seek recognition?
Strike the last word.
Gentleman is recognized for 5 minutes.
So I think the discussion from the other side aisle shows us where their priorities are. And it is to do what? Protect the insider in Washington, protect the Washington bureaucrats to the harm of their constituents. Why do I say that? They're saying what we're doing here today is making the CFPB suffer. What we're doing here today, they say, is making the Director Cordray suffer. Really? Someone who's making a 6-income salary is suffering? People over there who are working with high salaries are suffering? People over there are working in lavish facilities are suffering? I think not. An agency that is unaccountable to anyone. Did I say unaccountable to anyone? They are unaccountable to anyone. They are not accountable to the House. They are not accountable to the Senate. They are not accountable to the President of the United States. They are not accountable to the IG. This is not me speaking. This is what the CFPB told us when they came to this hearing. They are unaccountable to anyone. And they're the ones that are suffering? I think not. Who is suffering? The people who are experiencing racial discrimination at the CFPB's hands, they're suffering. The people who are living in conditions less than the lavish lifestyle of those over at the CFPB are suffering. Over at the CFPB, they are spending more on their facility, I understand, per square foot than the Palazzo in Vegas. The people back at home who are suffering because they cannot get loans now because of the CFPB. People in small businesses who are being put out of work. People in financial institutions who are seeing lack of ability to continue their job or make loans. Those are the people who are suffering at the hands of the CFPB, and the other side of the aisle wants them to go on unaccountable to anyone. So I will conclude where I somewhat began. I agree with you that the regulators did a terrible job prior to '08. The regulators who were independent back then failed to be accountable to anyone, and so Americans suffered because of their failure. Now you are going to continue that trend and that policy and the potential outcome by allowing the CFPB to be unaccountable to anyone. So I'll end with your own quote. It's not what you say, it's what you do. We on this side of the aisle are at least going to do something. We're going to hold them accountable. What do you want to do? Absolutely nothing. With that, I yield back.
Gentleman yields back, who seeks recognition. For what purpose does the gentleman from North Carolina seek recognition?
Strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I would like to thank the gentleman from Kentucky for this excellent legislation that's so important to protect the American consumer. And I am proud to be a co-sponsor of this legislation because it will put an end to an unaccountable and extravagant spending paid for by hardworking American taxpayers. It will help create accountability by finally subjecting the CFPB to the annual appropriations process. And by this, I yield to my friend and gentleman from Kentucky.
I thank my friend from North Carolina, and I appreciate his co-sponsorship and the support of this legislation. I'll take this opportunity to just respond to my friend from Colorado who had a few arguments made in opposition to the legislation, and he was referencing, I think, Chief Justice John Marshall's quote in McCulloch versus Maryland when he said, "The power to tax is the power to destroy." So a little twist on the argument that you're making. Of course, what we're talking about here is not the power to tax. We're talking about the power to spend. And the power to spend is not the power to destroy. We're restoring spending power where it rightfully belongs in the Congress. And in fact, as my friend, the gentleman from Texas, who has been a leader in reforming the structure of this agency, noted, my legislation does not in any way reduce the spending. In fact, it's an authorization bill. This bill authorizes for fiscal year 2017, $485 million budget for the Bureau. If you're for authorizing funding for the Bureau, you'd vote for my bill because it's an authorization bill. It's a bill that authorizing committees in Congress pass all the time. This is not unusual. This is the job of an authorizing committee to authorize funding, and appropriators then can appropriate within that authorization. Now, it would be obviously our responsibility to revisit authorization, just like every other authorizing committee does with other executive branch agencies. But that is the function of the Congress, to authorize and appropriate, to exercise the power of the purse. Now, I will concede to my friend from Colorado that the power to spend also implies the power to withdraw funding. And that is the mechanism that holds unaccountable, unelected bureaucrats accountable. What I think my friends on the other side of the aisle are missing in the debate, respectfully, and I have a lot of friends on the other side who genuinely believe that we should insulate these agencies from, quote, political pressures or from politics or partisan politics. But I don't believe this is about partisan politics. We are accountable. Every 2 years, James Madison said that you and me and all of us here, that we are accountable to the American people. So if we are subject to going back and talking to our constituents and listening to our constituents and going in front of the voters every 2 years, then we should be able to defend our decisions on appropriations. We should be able to defend our decisions on authorization. And what our constituents are telling us is that this agency is out of control, that they're actually hurting consumers. And so my constituents are telling me, reassert your authorizing authority over this agency. And if you believe that the mission is being fulfilled, then have that debate, go in front of the voters, and be accountable to the voters on those issues. That is what the framers of our Constitution asked us to do, is for us to be accountable. The problem is that unelected, unaccountable bureaucrats are not responsive to the people. They're not subject to elections every 2 years. So if you're for the Bureau, vote to increase their funding, vote to increase their authorization. If you think that they're doing a bad job, which is what my constituents are telling me, then I'm going to go home and I'm going to defend the fact that I'm reclaiming the power of the purse for Congress so that we can support the mission where it should be supported, or withdraw funding where it should not be. And with that, I'll yield back.
Gentlemen, yield.
I'll yield to my friend from, let me yield back to the gentleman from North Carolina first.
And I yield to my friend, Mr.
Well, I appreciate that. It struck me as I was hearing my colleague from Colorado, which I know in his heart he doesn't actually believe. It sounds like we ought to just put the entire government on autopilot, because the EPA, the Department of Transportation, NASA, I mean, those are all subject to the whims of Congress and all subject to those political pressures that are out there. We have a robust debate every year about budgets. We're going through it right now. And the appropriations process is that function, that constitutional function that we have. And with that, time is
I yield back.
Time of the gentleman from North Carolina has expired. Who seeks recognition? For what purposes? Gentleman from Massachusetts seek recognition.
Good morning, Mr. Chairman. I move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, sir. Let me just revisit the idea that this is just about accountability. I've been on this committee before the CFPB was created, and then during its life so far. From the very beginning, my colleagues across the aisle first your effort was to prevent the CFPB, the Consumer Financial Protection Bureau, from coming into existence, and that was clearly your intent. And you tried multiple times, you tried mightily, and I give you great credit, to stop the Consumer Financial Protection Bureau from coming into existence. And so you lost that one, and now so ever since you've been trying to destroy this agency, and in many innovative ways, defunding it. There are a lot of different ways you've attacked it, but to say this is not partisan in that respect, I think is laughable. So I think what really bothers some folks is that the Consumer Financial Protection Bureau actually tries to protect consumers. I think that's what's got a bug in your bonnet. And
Will the gentleman yield?
No, not yet. Perhaps at the end. And so that is really at the root of the dissension here. I want to say that this is not just a fight between Democrats and Republicans, however. What the CFPB is about is trying to protect the non-moneyed interests, the regular people that Republicans and Democrats represent every day. In this system that we have here in Washington, D.C., the number of lobbyists on behalf of the banks and the moneyed interests, let's put it that way, greatly dwarfs and outnumbers and outpowers and overwhelms the average citizen in our country. And that's the simple fact. They do not have the ability to weigh in. After Citizens United, and I won't go down that road, but the resources poured in here on behalf of the financial interests on both sides of the aisle in this committee is disgraceful. And so I think one of the counterbalancing entities in the financial world today is the CFPB and is Dodd-Frank. And one of the bills before us today would repeal Title II of Dodd-Frank, which authorizes the FDIC to resolve an insolvent bank holding company with more than $50 billion in assets or other financial institutions designated by the Financial Stability Oversight Council. Nearly $13 trillion in economic growth and $16 trillion in household wealth were destroyed. It just evaporated because of the reckless conduct of the banks during the crisis. And we try to put some things in place here that would prevent that from happening again. So just yesterday, the findings of the regulators, FSOC, found that Bank of America, their living will, their ability to be resolved in the event of a crisis was found to be deficient. Its provision of liquidity, including the need to fund a wind down, their governance mechanisms were not credible. Bank of New York Mellon, same thing, was found to be deficient in its operational capacity to ensure a wind down. J.P. Morgan Chase doesn't have a model to estimate or maintain sufficient liquidity. So they're going to go back and do the same thing. State Street Corporation, I love them, good people, but they lacked operational capacity to unwind. So we're going to go right back to the whole taxpayer bailout model again. Wells Fargo, they had material errors in its governance plan. Again, and I think it was Goldman Sachs, I don't know if they're down here, but they couldn't get rid of the derivatives, so they're in the same boat. So if this bill passed, we would go back to the model where the taxpayer bails out these banks when they get in trouble. And that's what you're pushing today. We're going back to that same model. I think it's and again, you know, I'm not saying that the financial services industry is just influencing Republicans. That's not what I'm saying. I'm saying they're influencing all of us. The money coming into this committee and to members on this committee is heavily biased in favor of the financial institutions. And I think we got to put in checks and balances. Look, I know my brothers and sisters on the other side of the aisle are good people. And I ask you to just take a pause and look what you're doing here. This bill is not in the best interest of the average folks that we represent. And Mr. Chairman, I thank you for your indulgence, and I yield back the balance of my time.
Time of the gentleman has expired. The chair now, for who seeks recognition? Gentleman from New Hampshire. For what purpose does the gentleman from New Hampshire seek recognition?
To strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman, for holding this markup today. This legislation doesn't eliminate the CFPB, but offers the opportunity to hold the CFPB accountable and allow Congress to fulfill its duty by properly overseeing an agency that, in many people's view, has consistently overreached their regulatory boundaries. That should be a concern to the very consumer we're trying to protect. I do support Mr. Barr's TAB Act, and I'm proud to be a co-sponsor of this legislation. The Act eliminates the direct funding of the CFPB by the Federal Reserve and subjects them to the regular appropriations process like every other financial regulator. It's just that simple. We should allow Congress to hold the CFPB accountable to the American taxpayer to ensure that there is no misuse of federal dollars within the agency. But unfortunately, the CFPB does have a track record of abusing taxpayer dollars. That is a fact. They spent the better part of $216 million renovating leased office building space. I would think that the consumers that we're trying to protect would want to be aware of that, are concerned about that, because $216 million may not sound like a lot of money to Mr. Cordray and the CFPB, but it certainly sounds like a lot of money, and it is a lot of money to the people I represent back in New Hampshire. And I'm sure that the average person who has to put money together every month to come up with their rent would be outraged at that issue. That's why we need to have this oversight and this obligation. The CFPB also aligned their salaries within the highest pay grades available within the Federal Reserve System. I'm sure everyone would love to have the highest salaries in their respective areas of work. But this is what they're doing with taxpayer money. There's also evidence that when particular employees lack the seniority or credentials to receive the highest salary tiers, alternative arrangements were made to provide equivalent pay. The employee reviews were essentially 100% for everybody. That's not right. And the American public needs to be aware and that this is happening. Oversight that we bring would allow that message to be clearly heard. H.R. 1486, I think, is vital to bringing the Bureau's level of accountability and transparency more in line with other financial regulators. For me, it's that simple. And I want to thank the gentleman from Kentucky, Mr. Barr, for authoring this legislation. I think it's critical legislation, and I would urge my colleagues to support this legislation. And I yield to the chairman the balance of my time.
Well, I thank the gentleman for yielding. I thank him for his leadership on this issue, for many issues dealing with CFPB. I do think it is important, though, to again focus on what the bill does from the gentleman from Kentucky. We have had long storied past in debating the relative merits of what CFPB is doing. The gentleman from Texas, Mr. Nagelbauer, said that everyone is for consumer protection. The ranking member, I think, said the proof is in the pudding. I guess I agree with both. Personally, I see an agency that has helped cause free checking at banks to be cut in half. That's harmful to consumers. I see an agency that is causing community banks to quit mortgages. That's certainly harmful to consumers. I see an agency that will make auto loans far more expensive for countless Americans. That's certainly hurting consumers. But ultimately, this is a far more profound question. And it is an Article 1 of the Constitution question. And I believe there are far too many agencies who are so-called independent agencies. One man's independence is another person's unaccountability. And I think the people of America are unhappy. I think they're restless. And I think that they see a certain arrogance coming out of these agencies that serve essentially as cop on the beat, prosecutor, judge, jury, and often recipient of the fine, and a surrogate legislative body all rolled into one. Again, Madison's very definition of tyranny. And so we can debate funding a CFPB. Frankly, if its mission was properly focused and if it actually, in its totality, helped consumers, I might want to double their budget. Presently, I think I'd like to cut it in half because I don't agree in cutting free checking in half. I don't agree with making auto loans more expensive. But this is about the people's elected representatives functioning as members of Congress with oversight and the power of the purse. And I thank the gentleman for yielding. Who seeks recognition? For what purpose does the gentleman from Missouri seek recognition? The gentleman is recognized for 5 minutes.
Mr. Chairman, I'm not going to take the entire 5 minutes. I'd like to associate myself completely with the comments from Mr. Lynch of Massachusetts. I too believe that we are, most of the people in Congress are trying to do the right thing. Yesterday, 2 days ago, I sat down with a career member of a federal department, and he said to me and some members of my staff, I don't know if you guys have any idea what it does to morale when you beat up on federal employees. This was not anyone from the CFPB. I was in my home district when I had this meeting. And I think it is something that we probably all do too much. And then we beat up on these folks, not understanding that for many people, they don't distinguish between what goes on in the IRS and those of us who sit here on this podium. The other part of it, I think we have to be very careful about talking about how the public wants us to you know, be the blockers for them. I'm not sure that we are held in high esteem. You know, we're not like up at the top of the poll. You know, according to some polls, we're slightly ahead of Satan. And so I think that we have to be careful about that, because when we attack the federal government, any part of it, we're attacking all of us. I think Will Rogers said things are turning around. The comedians are being taken seriously. The members of Congress have become the joke. So, I mean, I think we all need to work toward removing the joke compartment from who we are, and a lot of it we do it to ourselves, beating up on this government as our poll numbers go down. I yield back to balance my time.
Gentleman, yield back. For what purposes, gentleman from Pennsylvania seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I want to lend my strong support for H.R. 1486, the Taking Account of Bureaucrats Spending or TABS Act, sponsored by my good friend from Kentucky, Mr. Barr. As every high school civics student learns, the U.S. Constitution invests Congress, in particular the House of Representatives, with the power of the purse to tax and spend public money for the operation of the federal government. This structure was specifically instituted by our founding fathers because, as Elbridge Gerry made clear at the Federal Constitutional Convention, the elected members of the House are immediately the representatives of the people, and it was a maxim that the people ought to hold the purse strings. In other words, the power to tax and spend rests in the House because, unlike federal bureaucrats, we are accountable to the American people and thus are in the best position to determine how much to spend on various agencies and programs. Unfortunately, this has been forgotten or ignored by too many people here in Washington, D.C. It is the reason that we have seen the rapid rise of the administrative state. President Obama has made this Washington knows best form of governing a hallmark of his administration, and there is no greater example of this in practice than the so-called Consumer Financial Protection Bureau. Created as part of the Dodd-Frank Act, the Bureau is a uniquely undemocratic institution that is simply answerable to no one. It is led by a single director with almost limitless authority to regulate financial products and who cannot be fired. The Bureau also receives its funds directly from the Federal Reserve, subject to an opaque and arbitrary formula. To put this structure in perspective, other federal financial regulatory agencies generate their own funding through industry assessments. For example, the Office of Comptroller of the Currency, Federal Deposit Insurance Corporation, and National Credit Union Administration are all funded this way. Unlike these agencies, the CFPB does not generate its own revenues. Alternatively, where a regulator and industry interests are not aligned, they are funded by the annual appropriations process, such as with the Federal Trade Commission, who also has a mission to protect consumers, the Securities and Exchange Commission, Consumer Product Safety Commission, and Commodity Futures Trading Commission are examples of this structure. The Bureau, however, is an anomaly. It neither generates its own funding nor is subject to the appropriations process. Rather, Dodd-Frank allows the Bureau to determine its own funding allocations through the adoption of a perverse honor system approach to budgeting. The reason that the drafters of Dodd-Frank did this is obvious. By structuring the Bureau in such a manner, they could ensure that it would avoid actual, effective congressional oversight and scrutiny. And they could also shield the entrenched elites at the Bureau from the wisdom and preferences of everyday American people. As a consequence of this arrangement, the Bureau is expected to draw some $6.7 billion in federal funds over the next 10 years without the approval of the Congress and without any direction on how the money is spent. We are also likely to see more of the same from the Bureau, including wasteful and extravagant spending. This is what happens when you establish an organization that can govern by regulatory fiat. It didn't need to be this way, of course. In fact, prior to the final enactment of Dodd-Frank, many members from the other side of the aisle, including some here today, supported funding the Bureau through the congressional appropriations process. And the House version of the bill that ultimately became Dodd-Frank envisioned authorized appropriations when originally introduced by then-Chairman Frank. Today, we have an opportunity to begin to fix this. The TABS Act simply seeks to undo this error in judgment and make the Bureau the sort of responsive and effective agency that the American people need and deserve. To close, President Reagan famously said, "From time to time, we've been tempted to believe that society has become too complex to be managed by self-rule, that government by an elite group is superior to government by, for, and of the people." Of course, Reagan rejected this mindset, stating that if no one among us is capable of governing himself, then who among us has the capacity to govern someone else? We need to reassert our constitutional authority and put an end to the era of unelected and unaccountable elites here in Washington micromanaging the lives of everyday Americans. This is an opportunity. This is the first time that this Congress has to go on record with respect to actually authorizing spending for the Consumer Financial Protection Bureau. In this case, Mr. Barr's legislation is a $485 million authorization. You would think that our friends across the aisle would want to have this kind of funding authorized for the CFPB. With that, Mr. Chairman, I yield.
Would the gentleman yield for 20 seconds?
I would yield to the chairman.
I would.
I'm sorry, the gentleman yielded.
Yield to the chairman.
I think the gentleman from Wisconsin was seeking time.
I yield
If you would yield
to the
to
gentleman
him.
from Wisconsin.
If I could
It
just
is 10 seconds.
10 seconds. I am interested in the purity argument that's being made by my friends across the aisle that the CFPB is just looking out for the best interests of the American people. I would just ask, does anybody think that the trial bar gives money to one party over another? And do you think the trial bar has an interest in the coming arbitration rule that's coming from the CFPB?
Mr. Chairman.
I don't think the CFPB does not have a political...
Time of the gentleman has expired. Who seeks recognition? For what purpose does the gentleman from Missouri seek recognition?
Mr. Chairman, I move to strike the last one.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. And to my friends on the other side of the aisle, I suggest that a title for this bill would be how to best gut and control the CFPB. You know, my constituents appreciate the work that has been done to this point by the CFPB. Because before the CFPB, there was no traffic cop. There was no one standing there advocating for the regular American consumer. And I think it's disingenuous on the part of the other side of the aisle to say, oh, we need controls over this bureau, when they know in actuality they want to gut and control the CFPB. And at this juncture, I will yield the balance of my time to the ranking member, Ms. Waters.
Thank you very much, Mr. Clay. I'd like to continue to make the point that the proof of the pudding is in the eating when Mr. Nagelbauer talks about all of us being for consumer protection. And I'm going back to an article from the Washington Post in February of 2014, when they talked about a package of bills that would replace the Bureau's single director with a 5-person commission, prevent it from collecting consumer credit card information, make it easier for the Treasurer's Financial Stability Oversight Council to overrule CFPB regulations, and that, you know, again, they make the point that the Republicans have been trying to pass many of these things for years, which would hobble the fledgling agency's effectiveness by making it play defense, even though they never became law, those bills. But interestingly enough, perhaps the most important component has to do with money, they say. The legislation would change the CFPB's funding mechanism so that its budget comes from Congress rather than the Federal Reserve. It authorizes $300 million for each of the next 2 years, or about 2/3 of what the Bureau has been spending annually. After that, there's nothing. Per the House Financial Services Committee, GOP majority, and the Congressional Budget Office, it would save $5.4 billion over the next 10 years, which can only be true if the CFPB isn't funded at all. And some of the staff members, I'm told, said later that the bill only saves that much in the vernacular, and that they don't intend to zero out the Bureau's budget entirely, but that's what you do. So how is it you're for consumer protection when, in fact, you're moving in ways to wipe out the funding, period?
Would the gentlewoman yield?
I will yield, yes.
Well,
I'm sorry, it's Mr. Clay's time.
Yeah. Mr. Lacey, would you yield?
Would you yield to Mr. Nagelbauer?
Well, I appreciate the ranking member's comments. Has the ranking member read this bill?
Yes.
You have read it?
Yes.
Did you know what the funding level is that's authorized in this bill?
Well, the point that I'm trying to make is the consistency in how you attack the funding. That's the point that I'm trying to make.
So one, it doesn't cut the funding. And secondly, if the agency is doing as good a job as you have indicated you think it's doing, why then are you afraid to let the agency come and make a case before the United States Congress that funding should be increased or kept the same? So I think what the whole point here is if you're questioning whether you think the agency is actually doing.
Please allow me to reclaim the time.
Would you give it back to me, please?
I yield to the ranking member.
Thank you very much. I appreciate your comments, Mr. Nagelbauer, but I have no fear of anything. And so when you ask why am I afraid, I'm not afraid of anything. I am making the point that you are consistent in the way that you attack the Consumer Financial Protection Bureau. You find every conceivable way to do that. And I point back to February of 2014, where you attempted to do it in several different ways, and you continue that, even if you modify it somewhat. It is a continuous attack on the Financial Protection Bureau because you wish to kill it. Not, you made the point, or you tried to make the point, that everybody here is for consumer protection, but it does not seem to be the case based on the consistent ways that you try to undermine it. That is the point. You won't stop. You continue in every possible way to do that. I yield back to the gentleman.
The time of the gentleman from Missouri has expired. All members are reminded to address their remarks to the chair. For what purpose does the gentleman from South Carolina seek recognition?
To move strike the last word, Mr. Chairman.
Gentleman is recognized for 5 minutes.
And I'm sorry that my friend from Colorado has left, because these are actually, I wanted to respond to a couple of things that he said, because he said some stuff that I think he meant in the nicest of ways, and I appreciate the level of his rhetoric. It wasn't fiery and combative. But if he were here, I would ask him if he really believed what he meant or believed what he said. What he said was that, and I'll paraphrase, anything that helps consumers needs to be beyond politics. And that's been the justification by both the gentleman from Colorado and many folks on the other side of the aisle, that anything that benefits consumers, we need to take that away from the politicians. It's too important to leave in Congress. Do you really believe that? Do you really, really believe that? And that's what I would ask him if he were still here. EPA helps consumers. The FAA helps consumers. You can make the case that the USDA helps consumers. The FDA helps consumers. Do you really believe that anything that helps consumers should be beyond politics? Because if you do, why are we here? Why are we here at all? We shouldn't be here. If you really believe that you believe that Congress does not have the ability to oversee organizations that help consumers, including the CFPB, if you really believe that, go home. That's our job. It's what we're supposed to be doing. And you may think we don't do a very good job at it, and you may think that there's various interests at play that prevent us from doing a good job at it, but if you really believe that it's so important that we cannot, by our nature, do it, then quit. Because you're wasting your time here. I heard him say that, that in a world, it's enough for us to be able to override rules and regulations. We can override rules and regulations at every single one of those other agencies I just mentioned. That cannot be enough. That cannot be enough. The funding of the agencies speaks to the very heart of why we are here. The input into how they spend our taxpayer money is fundamental to the purpose of Congress. He also implied, and I think he used the word, moneyed interest. It's too difficult to do in a world of moneyed interests. And I know it because I know my friend from Colorado. He was sort of, it wasn't just tongue-in-cheek, but it was sort of aimed at my side of the aisle more so than his. Really? Y'all don't have moneyed interest on your sides? You say that we aren't able, or you suggest that we aren't able to stand up to the moneyed interests on one side of an argument. But as several folks have mentioned over here, you have the same pressures on your side. The Sierra Club is just as active as oil companies. The plaintiffs' bar is just as active as large corporations. The trial bar, the unions are just as active on your side. Are you admitting that you can't stand up to those as well? Because that's discouraging. So I wish he were here. I wish Mr. Perlmutter was back and we could continue the conversation, because I really don't believe he meant what he said. I understand in the moment that this is an argument that you can make, but I'm hopeful that none of us here really believe that if it helps people, we shouldn't be involved with it. In fact, the exact opposite is true. With that, I yield back the balance.
Would the gentleman yield?
Be happy to yield.
I thank the gentleman for yielding. I would say to the ranking member, I hope she's listening, that, if with you and I've had this conversation about the organizational structure of the CFPB, and you have been against having having a 5-person commission. And I would remind the ranking member that if I wanted to eliminate the funding levels of the CFPB, the best way for me to do that is when I leave office here in January 4th, is ask the new President of the United States to appoint me to be the new CFPB director. And
will the gentleman yield?
Yes.
Where do I write the letter of recommendation?
And the funding level request for the next year would be $50,000. And you would have absolutely no say-so in that. And I think y'all have to think about that. I mean, what's good now is because you have a democratically appointed CFPB director. But if you get a Republican appointed one, and he wants to fire half or all of the people there, if he wants to eliminate his budget and sit in his office and answer the phone all day long, there's absolutely nothing that you can do about it. So I think when you're against accountability, I think you have to understand that that may look like a good plan today, but it may not look like a good plan in the future. And with that, I yield back to the gentleman and thank him for his time.
Does the gentleman yield for a moment?
You can have all 7 of my
All
seconds.
7 seconds. I'd just like to respond. First of all, I don't think that President Clinton will be appointing you, Mr. Neugebauer. Second of all, my answer is do it. If you win the presidency, do it.
Reclaiming
Shut it down. Shut down the
Time
environmental.
of the gentleman has expired.
Shut him down. Go ahead. Let's see what the American people say then.
The gentleman is out of order.
President Sanders might.
Time of the gentleman has expired. For what purpose does the gentleman from Illinois seek recognition?
Thank you, Chairman. Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you so much, Mr. Chairman. I want to thank Congressman Barr from Kentucky for putting forth this TABS Act. I'm proud to be a co-sponsor of this important piece of legislation. And Chairman, I also want to thank you for including this bill in the markup today. I am beginning to lose track for how long we've raised the issue with exorbitant spending the Bureau has planned for itself. I cannot remember receiving any phone calls or letters from my constituents requesting that the Bureau have a waterfall in its lobby, probably because they know that this isn't necessary for implementing and enforcing financial regulations. Furthermore, I regularly hear from financial services providers across Illinois that the CFPB is not responding to their thoughts and concerns. How many times and for how long have we requested bipartisan, common-sense policies that would provide meaningful relief for our nation's community banks and credit unions? Heard the chairman earlier today say that we're losing a community bank a day. I think it was close to this time last year that hundreds of members, Republicans and Democrats in the House and Senate, sent the CFPB a letter asking for more time to implement the TILA-RESPA integrated disclosures. The CFPB brushed off our concerns. Just a week or so ago, I received a long letter from a constituent expressing disbelief in how the process is supposed to work compared to how it actually functions in the field. The CFPB claims they listen directly to the American people through their consumer response portal, but we know that this is little more than selective listening. The TABS Act is another embodiment of this committee's frustration with CFPB. CFPB seems to have a steadfast mantra that they think we are right, the CFPB is right, and Congress is wrong. While I was not serving in Congress at the time when this Bureau was dreamed up, and I know many of my Republican colleagues raised concern with the new agency's unprecedented independence, we have now seen some of the disastrous effects of a regulatory agency that has close to no accountability to the American people. The Constitution is clear, it remains clear, that the power of the purse is only with the people's house, not unelected bureaucrats. It's not to say the Bureau is always acting improperly. The Dodd-Frank Act did give them a statutory mandate. However, as is commonplace with other regulators, oftentimes congressional intent needs to be clarified. Our country is based on the premise of elected government, and I do not remember an opportunity where my constituents were giving a meaningful say in how the Bureau will conduct itself. Putting the Bureau on appropriations should not necessarily be considered a reprise of its policies, but will help ensure they are listening to the American people. Just as we debated with Chairman Nagelbauer's bill to put in place a bipartisan commission at the Bureau, this should not be a partisan issue. However, right now, I'm hearing from my constituents that we need more accountability, and I'm really pleased to support this legislation and would yield to the sponsor, Congressman Barr, for the remainder of my time.
Thank you to my friend and gentleman from Illinois. And let me just kind of conclude my thoughts as I listen to the debate on today's bill, the TABS Act, which I'm proud to introduce and support. It sounds to me like today's debate is fundamentally about the nature of our democracy, fundamentally about the nature of self-governance. The question we are asking today is this: do we still believe in government by the consent of the governed? Or do we want to abandon that time-tested democratic principle and declare that policy decisions should be delegated to unelected, unaccountable bureaucrats in the executive branch, out of the ability of this body, of the House of Representatives, to control those decisions? When I go back home, people ask me, what's your biggest surprise in the three and a half years that you've been in Congress? And the biggest surprise, I have to admit, is that Congress doesn't run the country. Unelected bureaucrats in the executive branch run the country. We can't control what goes on in this country anymore because the laws are written by and large by people who are not even elected by the American people. And so when I listen to my friends on the other side of the aisle, and I know they're well-meaning here, they think that they're doing the right thing, but it sounds like what they're saying is that the American people are incapable of governing themselves through their elected representatives. It sounds like my friends on the other side of the aisle are saying that they're incapable of representing their constituents. I know that not to be the case. I think we can listen to our constituents, and we do go home and listen to them. And what they're telling us is that they're tired of unelected, unaccountable people who they don't get to vote for running their lives. And so maybe one of the reasons why Congress is not held in such high esteem is that we've given away the power of the American people to people who don't represent them. And so it's time for us to stand up for our democracy, for Congress, and reclaim the power of the purse. And I'm proud to support this legislation. Yield back.
Time of the gentleman from Illinois has expired who seeks recognition. For what purpose does the gentleman from Texas seek recognition?
To strike the last word.
The gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I believe this is the latest effort to emasculate and eviscerate the CFPB. It took 66 years to get Glass-Steagall, but they got it. Glass-Steagall was passed after the crash of '29. It separated investment banking from commercial banking. It was a good piece of legislation. It took 66 years, but they got it. The effort to eviscerate the CFPB started before there was a CFPB. There was a fight to prevent it from coming into being. Then there was a fight to prevent it from having a director. And now we have the latest fight. This is just one in a long line of fights that we will have to endure. We have to protect the CFPB every single day. It is constitutional. Not one court has said that this law is unconstitutional. It's lawful. It's something that Congress passed. It was an act of Congress, in fact, an act of a Congress willing to act. This Congress so far is not willing to act nearly as much as the one that passed this legislation. But I want to focus on something that's more important to my heart as opposed to my head. When President Obama signed Dodd-Frank into law, he signed it with ink, but it was written in tears. It was written in the tears of the victims of CDOs, collateralized debt obligations, credit default swaps. It was written in the tears of people who were evicted from their homes, who were foreclosed on. Millions of people foreclosed on, lost their homes. It was written in the tears of the millions who suffered as a result of the '08 catastrophe. This piece of legislation is designed to protect consumers. Unfortunately for some, because many would have it be the Financial Protection Bureau. Protect the financial institutions. Protect those who are into payday lending. Protect those who are ripping off minorities with these auto loans. I am prepared to debate auto lending. I am prepared to debate payday lending because I see the invidious impact that it has on people in this society. So I'm going to stand against the legislation because I stand for consumer protection. And this piece of legislation is probably the best that we are going to get in my lifetime. And if we lose it, we won't acquire it again in my lifetime unless we have another 2008 catastrophe. With that said, I will yield to anyone who desires time. No one desiring time, I will yield back the balance of my time.
Gentleman yields back. For what purpose does the gentleman from Michigan seek recognition?
Mr. Chair, I ask to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, and sorry I had to step out for a meeting with some constituents, and I caught the last part of my colleague from Texas' discussion. I'm here for a protection as well. I'm here to protect the Constitution, and I'm here to protect the standing of this legislative body and where it comes and intersects with all of our own personal rights. This is a fundamental question that the Founding Fathers debated and wrestled with. How do you best protect individual rights? How do you best protect a class of people that may not be in the majority. You give them representation. You give them an equal voice in a legislative body such as this. In fact, we went so far to say we don't even want population to dictate what's going to happen. We're going to make sure that they have a legislative body that has equal representation for each state. Now, earlier, one of my colleagues from Colorado, who I said earlier, I don't truly believe that he thinks this, and in his heart he knows better. And I only half-jokingly say, based on some of the things that we've heard today, we've got colleagues on the other side of the aisle who believe we ought to put the entire government on autopilot, who believe that the whole government should be, quote, off budget, with no legislative input, no budget process, no appropriations process, and move forward because it's the best thing to do and it will insulate it from all of those political twists and turns. Well, ladies and gentlemen, that is not how our process works. That is not how the Constitution works. This body, as was pointed out by the author, Mr. Barr, is intended to be close to the people by being elected every 2 years, by being responsive, by understanding that if the government goes in a direction and the American people say, hey, wait a minute, time out, you went a little too far, a little too fast, whether it's in the Obama administration or the Bush administration or any other administration that was before them. They have their opportunity to go from a 2004 election to 2006 and say, time out, time to put another team in. They have the ability to go from a 2008 election to a 2010 election and say, time out, time to put another team in. And when I've got the ranking member talking about the head of this department, which is completely unaccountable, suffering intimidation and bullying and the whims of Congress, it's laughable. So, this Bureau, by the way, the proper name is the Bureau of Consumer Financial Protection, emphasis on the Bureau part. This Bureau won't listen to polite requests. This Bureau won't listen to a directive from this body. This Bureau ignores the people's house. And how do you think you get their attention? You start ramping up the pain. You start ramping up the direction that we want to go. And they try to, this is the equivalent of if anybody watches soccer out there, or football, this is a flop, all right? There's a minor little hit, and they're flopping. Oh, how could we be so vilified? Are you kidding me? They won't listen to anybody. This bill, which I am proud to support, takes off the issue of, okay, if you think we're trying to financially gut them, we're going to give them the exact same money that they had in this last budget, which was voted for and signed by this president, voted for by members on the other side and signed by this president, $485.1 million. Now, somebody earlier had said, well, there's a pattern. There's a pattern of aggression towards this. 22 members of the Republican side of this committee weren't even in Congress when Dodd-Frank passed and the CFPB was created. 24 of them weren't even on this committee. That's 2/3 of the committee. 70% of us weren't even on this committee. And at least 10 of my colleagues over on the other side were not here when this Bureau was created. But we're not supposed to have any input? We're not supposed to have any kind of say as to how they are going to be accountable? That, to me, is puzzling as I see my colleagues time and time and time again give up their constitutional standing, and it has to stop. And with that, I yield back.
Time of the gentleman has expired. Who seeks recognition? There being no further discussion or amendments to the bill, the question now occurs on adoption of the substitute amendment offered by the gentleman from Kentucky. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment is adopted. The question now occurs on ordering the bill as amended reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it, and the ayes have it. For what purpose does the gentleman from Texas seek recognition?
Ask for a recorded vote.
Recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 4894. The clerk will report the bill which was distributed in advance.
H.R. 4894, to repeal Title II of the Dodd-Frank Wall Street Reform and Consumer Protection Act. Section
Without
1.
objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Georgia, Mr. Westmoreland, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman, for bringing up H.R. 4894. It's a simple little bill. It's only 5 pages, yet it's an important bill. As many of you know, for a long time, I've been concerned by the orderly liquidation authority created by Title II of the Dodd-Frank Act. The 2008 financial crisis gave the American people an insight into the way our financial regulators operate. Unfortunately, Americans also saw that, in fact, it was the government regulations that created the conditions leading to the financial crisis. The Dodd-Frank Act also gave these same regulators who failed to stop the financial crisis even more authority than they had before 2008. Let's think about that for a moment. The regulators who contributed to the causes of the 2008 crisis are now expected to see and stop the next crisis. Call me skeptical, but I just don't see how this is good for anyone but the bureaucrats themselves. Furthermore, the financial crisis and Congress' reaction to it created the idea of moral hazard and too big to fail. This dangerous concept now lives on through the Dodd-Frank Act. When the government chooses to bail out some firms but not others, the government picks who wins and who loses. Title II and OLA codified too big to fail. Although some may argue that it is necessary for the government to step in and manage a liquidation process, I wholeheartedly disagree. The only thing OLA achieves is a shadow regulatory state that has a profound impact on our financial markets. The AIG bailout is a prime example of why Wall Street fares well with OLA and the Title II. AIG creditors and counterparties were paid off 100 cents on the dollar. In this very committee room 3 years ago, I asked Mr. Jeffrey Lacker, president of the Richmond Federal Reserve Bank, if Dodd-Frank's orderly liquidation authority provides the opportunity for more AIG-like bailouts, where hardworking, tax-paying workers in my district would end up bailing out the creditors of European banks 100 cents on the dollar. And Mr. Lacker confirmed my suspicion. His quote was, "The way that the orderly liquidation authority is envisioned to work, with a single point of entry, a parent company, it envisions providing funds from the FDIC that would let creditors of operating subsidiaries escape losses." So I would have to say that your characterization is accurate, that it could happen again. In fact, the FDIC's availability to access the orderly liquidation fund abandons the principles of a free market, which would normally not insulate creditors and investors from the consequences of their poor choices. Because of Title II, the too big to fail or large institutions have a competitive advantage that only contributes to these firms getting even bigger and small firms getting even smaller. Orderly liquidation authority within Title II of Dodd-Frank creates a distorted market and unnecessary option for the government to come in and take over a failing firm's liquidation process. This is why the repeal of Title II is necessary. This bill not only repeals what I believe is a misguided policy, but H.R. 4894 in its simplicity will also save American taxpayers money. It is Congress' distinct duty to provide a budget for the United States. Now the Financial Services Committee is acting alongside with other committees to put our money where our mouth is. If you believe, as I do, that Congress needs to lead by example and reduce out-of-control mandatory spending, then we must start here today with a legislation that will save taxpayers money not only for this fiscal year, but also for the next 10 years. This is exactly what H.R. 4894 will do. Initial CBO estimates of this policy show significant savings of $21.3 billion over 10 years. This number alone shows that any member who is serious about the fiscal responsibility would vote yes for this bill. In closing, I believe 4894 is the kind of bill we should be supporting not only for all of our constituents who pay taxes, but also for all of our small community financial institutions that we represent. H.R. 4894 ensures to our local financial institutions that we are not going to allow a system that leaves them behind or that tips the scales in any one institution's direction. I urge all my colleagues to vote yes on H.R. 94, and thank you, Mr. Chairman, and I yield back.
Gentleman yields back. Who seeks recognition? What purpose does the gentlelady from Wisconsin seek recognition?
Thank you, Mr. Chairman. I have an amendment at the desk.
We'll pause and allow the amendment to be distributed. Have all members received a copy of the amendment? The clerk will report the amendment.
Amendment in the nature of a substitute offered by Ms. Moore. Strike all after the enacting clause and insert the following. Section 1, ex ante assessment. A.
Without objection, the reading of the amendment is dispensed with. The gentlelady is recognized for 5 minutes on her amendment.
Thank you so much, Mr. Chairman. And I would say that if Mr. Westmoreland's amendment, if there were a $22 billion line item in the Treasury Department where we could create these savings, this might be a very attractive bill. But there is no $22 billion to save here. What he is doing with this bill would be to destroy the orderly liquidation assessment authority process, which is very, very dangerous. For those of you all who served on this committee, as I did, when Mr. Paulson came and said, give us $700 billion to bail out the financial system, if all of you remember that, we don't want to go through that again. So we put together this orderly liquidation authority so that we could orderly help these SIFIs to fail. Now, I want to remind you all, so what my amendment does is it restores the orderly liquidation authority to what was intended in our original Dodd-Frank bill before then Senator Scott Brown of Massachusetts objected to it. And in order to get his support, we needed to do it, and it also offended Wall Street. What we did at first was to say, look, we're going to assess all of these SIFIs up front so that if there were ever a need to resolve any of these companies, we would have the appropriations to do that. Well, when that was rejected, we then reverted to what we currently have, and that is an imaginary accounting gimmick to say that if we are ever faced with this situation again, we would resolve the SIFI, and then afterwards we would assess, we would have a ex post assessment to recoup the taxpayers' money. So that's what we have now. So my amendment makes it an ex ante assessment. What we do is we do what we intended to do at first. We assess the money now from these SIFIs, literally have an account so that if this happens, we can do it. Because right now, I just want everybody to know that this is number one, unworkable. I'm asking you, since my time is waning, we had witnesses that testified on this bill. They say that this is insufficient a mechanism. And so read the testimony of Donald Bernstein of Davis Polk Law Firm, Richard Levin of the National Bankruptcy Conference, before you support Mr. Westmoreland's legislation. What this will do is that it will create a fake savings of $22 billion. There's no there. There's no $22 billion sitting in Treasury right now. And it would destroy the orderly liquidation authority, and we'd be right back where we were in 2008 when Mr. Paulson came with his 3-page bill asking us for $700 billion. You know, we've had the Fed and the FDIC rejecting the living will concept. So unwinding these enormous financial institutions in an orderly way is beyond the ability of a bankruptcy court. And the CBO rightfully points out that all the costs could be recouped currently, and so this savings is absolutely a fiction. I have 33 seconds left. I am asking you again to really think about this as a silly gimmick accounting scam, or what some members of the Judiciary Committee heard, calling it something else. I guess, Mr. Westmoreland, I don't want to disparage your efforts here to come up with a savings, but I am only submitting to you that it's not real. And I yield back.
Time of the gentlelady has expired. For what purpose does the gentleman from Georgia seek recognition?
Strike the last word.
The gentleman is recognized for 5 minutes.
You know, the gentlelady brought up SIFI, and hopefully that'll be the next thing that we can eliminate is the Title I of this, because of the way the SIFI is done. But the $21.3 billion is over 10 years. And so this is the CBO estimate. So you're using CBO numbers one way. I'm using what the CBO said, significant savings over a 10-year period. So who knows? You know, CBO can be confusing, but since they have estimated the $21.3 billion, then I'm going with that. The other thing is, there was up on the board, it said something that the other side of the aisle put up, that the financial crisis cost Americans more than $13 trillion. The federal government cost the American people over $13 trillion. I lost more community banks than any other congressional district in the United States. And so we had people lose their family fortunes, their colleges fund, their retirement, and everything else because of the lack of, or the government picking winners and losers. And you go back to the bankruptcy, and we just passed a bill yesterday by Mr. Trott from Michigan that answers some of the questions about how these financial institutions can go through bankruptcy. And let me say this, why did the government bail out Bear Stearns, then let Lehman go bankrupt, and then bail out AIG? And AIG, when it was bailed out, their subsidiaries and foreign banks got 100% of their money back. Now, in the case of Lehman, people who had made bad investments and took personal responsibility had to go through the bankruptcy process. And it went very orderly. Did everybody get everything they had in the pot? No. But I don't think it's government's responsibility to make sure that everybody that invests in an institution or a company or anything else, that the government owes them 100% of what their investment was if something happens to the company. And so if you look at Bear Stearns and the bailout and what they did, that is one of the things I think that made the market so unstable. And then coming back and letting Lehman go bankrupt added more confusion to the market. And then coming back and bailing out AIG. I mean, this has got to be very confusing to the market in what some of these big companies are going through. So I would be against the lady's amendment, and I hope that members will support this simple little bill, 5-page bill, that simply gets us out of the business of picking winners and losers, and we'll let them go through the process of bankruptcy like anybody else. I yield back.
For our purposes, the gentleman from Connecticut seek recognition.
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. And let me start by saying I consider Mr. Westmoreland a personal friend, and we do some really good work together on the Intelligence Committee. So I will keep my remarks as constructive and as nonpartisan as I can, knowing that he's making a good faith effort around his conservative principles here. But I am stunned that my friends on the other side of the aisle who enshrine conservatism would offer a repeal of Title II. And I say that really for two reasons. Number one, Title II is the one part of Dodd-Frank where the language says bailouts will be prohibited. It's in Title II. If we do away with Title II, the language that prohibits bailouts will go away. And we could debate the merits of that particular part of Title II, but let's just be clear that if we do away with Title II, we're doing away with the statutory prohibition on bailouts. Secondly, though we're having a real debate over the causes of the crisis, or had a real debate over the causes of the crisis, everybody agrees that the uncertainty that surrounded the meltdown of Lehman Brothers and AIG and Bear Stearns, as Mr. Westmoreland said, was far from a good way to handle an economy-challenging event. And Title II, of course, sets up a mechanism to avoid that uncertainty. It creates authorities that are no more obtrusive than the authorities that the FDIC has exercised for generations in the resolution process, but it sets up very clear authorities. It prohibits bailouts and sets up authorities for the resolution of failing systemically important financial institutions. So I'm at a loss to understand why anyone, much less a conservative, would want to repeal Title II. Now, we're having an interesting debate. I'm actually sort of fascinated by the question of whether we have dealt with too big to fail. We don't really know. Now, of course, a lot of people assert with great certainty that we have or we haven't. But Chairman Frank, whose name is on the bill, lots of people say that we're safer, say that maybe in the most stressful scenarios we might not have done. Anyway, it's an interesting debate. But what is unarguable is that banks are safer today with more capital, out of businesses that were as dangerous as there were, and those non-banks, because remember, Bear Stearns, Lehman Brothers, and AIG are not banks, those non-banks that were so at the core of the meltdown now have, thanks to Title II, some supervision and a mechanism for their resolution should we need it. There's really three things you can do if Lehman Brothers in the future were to go down. You could go through bankruptcy, and I would note, and this is really important, that just today the FDIC and the Federal Reserve said that at least 5 of the institutions' living wills are insufficient and indicate that they wouldn't actually be able to go through a bankruptcy process in an orderly way. You could do what some people are saying, which is break these things up. And again, Chairman Frank has some thoughts on that, and obviously the presidential candidates are talking about that, but we're obviously not doing that. So that leaves, very simply, the orderly liquidation process that is in Title II. So I think, and this is what brings me back around to Ms. Moore's amendment, We had, as Ms. Moore said, an interesting fight about whether we should create an ex-ante fund, as she seeks to do today. And in the end, there was support for that. But in the end, we didn't have an ex-ante fund. We had a commitment to go get the money if you needed it afterwards. Well, if you need it, and then you're going to go get it later, there's a timing lag there. It's going to take you some time. And that's where this sort of phantom money comes from, because the Treasury would need to advance funds for a liquidity facility, but they'll get it back. So again, I'm not quite sure why we'd want to do away with Title II for the reasons I'm outlined, but let's be clear that we're finding money now, I think for the Republican budget, $19, $20, $21 billion, from a mechanism that is really a timing issue that we have because the majority opposed an ex-ante fund. So we're in this sort of weird circle now where we're finding money where it doesn't really exist. But most importantly, and I'll just close with this point, again, with all due respect to my friend Mr. Westmoreland, I just don't understand why we would do away both with the prohibition on bailouts and by the mechanism, and the only mechanism we have today, as imperfect as it may be, to unwind a future Lehman Brothers, a Bear Stearns, or an AIG. And with that, I'll yield back the balance of my time.
Gentleman yields back. For what purposes? Gentleman from Texas seek recognition.
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I want to commend the gentleman from Georgia, my good friend, Mr. Westmoreland, on introducing this important piece of legislation. Mr. Chairman, something that is often said in these hearings is the need to protect taxpayer liability. Indeed, during the financial collapse of 2008, the amount of taxpayer liability was quite large. In fact, one of the reasons often given for the passage of Dodd-Frank and the creation of the CFPB was to protect consumers and their liability. The Dodd-Frank Act categorically states that taxpayers shall bear no losses from the exercise of any authority under Title II. Well, Title II also contains a provision that would essentially pay back the taxpayer if the government loses money. But this administration's track record is very clear on racking up debt, racking up liability on the backs of the taxpayer. This open-ended taxpayer-funded bailout is what people back home don't understand. If a large financial institution is going to collapse, then they should settle their debt in bankruptcy court, not to have it decided by unelected bureaucrats in Washington. Despite assurances by President Obama when Dodd-Frank was enacted, taxpayers are no less protected than they were 5 years ago. By allowing regulators to develop and implement orderly liquidation authority, future bailouts will continue to exist, again, putting taxpayers on the hook. The OLA process is free to pick winners and losers instead of operating under legal precedents and the rule of law. Although the next bailout hasn't happened, it is nearly impossible to determine what its financial costs may be, but most likely trillions of dollars will be borrowed from the U.S. Treasury. H.R. 4894 repeals Section 2 of the Dodd-Frank Act and does away with this too-big-to-fail taxpayer funding bailout. Make no mistake, instead of costing taxpayers and increasing America's debt, H.R. 4894 has the potential to save hardworking Americans billions of dollars. In my book, that's a no-brainer. I urge passage of Mr. Westmoreland's bill and ask members to reject the amendment by Ms. Moore. With that, I yield my time back to you, Chairman.
I thank the gentleman for yielding to the chairman. I think perhaps in addressing the gentlelady from Wisconsin's amendment, the only thing worse than a post-funded bailout fund is a pre-funded bailout fund. A bailout fund is a bailout fund is a bailout fund. If you want to give a big wet kiss to Wall Street, let them know that, you know what, we're serious. We will bail you out when you have trouble. We'll go ahead and fund it now. And we'll tell everybody that the taxpayers will never have to be on the hook. You know, we heard the same things with the National Flood Insurance Program. These are the same people who said, well, you know, I want to roll the dice a little bit more with Fannie and Freddie. So I don't doubt people's hearts, but to say that taxpayers ultimately won't be on the hook, I just don't think has any credibility. And bottom line is it comes down to the fact, do you believe that there are institutions that are too big to fail and need to be bailed out? If you do, you support Dodd-Frank and you support the gentlelady from Wisconsin's amendment. And I'll at least salute her for this. At least some Democrat is willing to amend Dodd-Frank. And so I applaud her for stepping forward to do that. I don't necessarily think in a beneficial way. Under Dodd-Frank, we already know that the big banks have gotten bigger, the small banks have gotten fewer. If there's any, I can't think of a section of Dodd-Frank that has contributed more to systemic risk than Title I and Title II. To designate banks as too big to fail and then to set up a bailout fund, regardless of whether it's funded ex ante or ex post, it doesn't matter. It's still a bailout fund. And either you believe that these institutions should be resolved through bankruptcy or you believe they should be resolved through federal bailout. Our side of the aisle says no. Nobody should be above bankruptcy. And if you lose your ability to fail in America, you're going to lose your ability to succeed. And with respect to this figure that's been tossed about by CBO, frankly, I think it's terribly lowballed. We know under Title II that FDIC can borrow, I believe it's up to 90% of the assets of a failing institution, trillions of dollars ultimately that the taxpayer could be liable for. We are becoming ultimately a backstop, bailed out, bankrupt society, and it has to stop. We need market discipline. In other words, the appearance and reality that your own money is at risk. That is the best way to reduce systemic risk within our system. It is not federal micromanagement. It is not bailout funds. Allow failed institutions to go bankrupt so that others can thrive and so that hardworking taxpayers can achieve financial independence. I thank the gentleman for yielding. For all purposes, for the ranking member seek recognition.
Move to strike the last
General lady is recognized for 5 minutes.
Mr. Chairman and members, I support Ms. Moore's amendment. And I would like to highlight just how reckless the legislation we are considering, H.R. 4894, is. Just this morning, the Federal Reserve and the FDIC jointly determined that, and I quote, the resolution plans of Bank of America, Bank of New York Mellon, J.P. Morgan Chase, State Street, and Wells Fargo are not credible or would not facilitate an orderly resolution under the U.S. Bankruptcy Code. Our regulators who have made a portion of these plans available to the public are telling us that if these 5 banks fail and go through bankruptcy, they will likely cause a repeat of the 2008 financial crisis. I and my fellow Democrats do not want to see the foreclosure of millions of Americans' homes or pink slips laying off millions of our constituents. For this reason, Congress adopted Title II to ensure that no institution, even one that cannot go through bankruptcy, could still fail. With this declaration, it is my understanding that the clock for these institutions will begin ticking on October 1st, 2016. That is, Bank of America, Bank of New York Mellon, J.P. Morgan Chase, State Street, and Wells Fargo will have 2 years to put together a credible plan by addressing their deficiencies in governance, liquidity, provision, and structure, or the regulators will begin to break them up. I agree that this has been a painfully slow process given that nearly 8 years that have passed since Lehman Brothers failed. And I'll remind everyone that it took 8 years of the Bush administration to get us into this mess in the first place. If my Republican colleagues have ways to expedite this process, I would like to see them. It's very interesting. When we have people talking about breaking up the big banks, and my friends on the opposite side of the aisle allude to it time and time again, but they don't say how. As a matter of fact, it's very interesting that all the presidential candidates are out there talking about what they want to do. They don't have a clue, and they don't have a plan except for one, and that one happens to be on the Democratic side of the aisle, who knows how this works and what orderly resolution is all about. And so not only do we have, members of Congress who are running for office who don't know how and what to do, even though they allude to breaking up the big banks. It's evident in listening to my colleagues on this side of the aisle who talk about breaking up the big banks, that they don't have a plan. To the American public listening today, I hope they understand just how absurd the legislation we are considering is. after our regulators have determined that most of the largest banks can't go through bankruptcy without harming our economy. The Republicans want to ensure that their failure does harm our economy. So let me just say that I think one of the brilliant points of Dodd-Frank is Section 2, because we give the banks an opportunity with these living wills to reveal how they are organized and how they operate. And now we have the mechanism in place to determine where the risk is. And we can help them to wind down, to separate, to do something to get rid of the risk. And we have a way of orderly resolving these institutions if, in fact, we determine that this real risk exists. So I don't understand what the opposition is. You say you want to break up the big banks, but you don't say how. We tell you how it can be done. It is in Dodd-Frank, my friend, Mr. Westmoreland. And I want to say that just as everybody started out their conversations and their testimony and their comments with they're your friend. You're my friend too. But I disagree with your legislation, and I disagree with the fact that you think that this can all be handled through the bankruptcy process. I will yield back the balance of my time.
Gentlelady yields back. For what purpose does gentleman from Texas seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Yeah, well, thank you, Mr. Chairman. Well, I rise in opposition to the amendment, but in support of the underlying legislation. You know, really what Title II is because we were all told that Dodd-Frank ends too big to fail. But as the chairman mentioned, the large banks have gotten larger, and unfortunately our smaller banks, our community banks, are going away. So what Title II is the parachute clause. It says, you know, we are going to do all of these things, and we've got the regulators telling us about establishing all of these various hoops for these financial institutions to run through living wills and stress tests and all of these things, and we're now on 2 or 3 itinerations of capital requirements. And what they're saying is we are doing our part to make these entities too big to fail. But just in case we get it wrong again, like we did in 2008, we've got this little provision here where we can bail out these entities. And how do we do that? Well, the gentleman a while ago said that that the taxpayers under provision Title II don't do the bailout. Well, let's go through the process. So if the FDIC steps in and they take over an entity and they need $100 billion, what is the process to get $100 billion? FDIC doesn't have $100 billion. And so what the process is they issue bonds. Guess who buys the bonds? The United States Treasury. Guess where the United States Treasury gets their money? They get their money from the taxpayers. So basically, eliminating Title II basically does eliminate the taxpayers having to be on the forefront of running any of that because it takes away an important funding process, and that is, which is the CYA for this particular Dodd-Frank provision of ending too big to fail. So with that, I'd like to yield to the author of this piece of legislation, Mr. Westmoreland, the rest of my time.
Thank you for yielding. And ranking member, I didn't realize that Mr. Sanders had a plan for this because I don't think he would want too big to fail either. He would probably let the bankruptcy process go through. But on the Moore Amendment, it actually, establishes a $150 billion slush fund for bailouts. And not only did the Republicans reject this during the discussion of Dodd-Frank, but Mr. Frank himself rejected a bailout slush fund. And as the chairman mentioned, what better way to ensure these people to act irrationally with some of these investments if they know they've got a slush fund right there ready to bail them out. We're not, we're not out of this economic storm yet. And the reason we're not out of it yet is because we have lost so many of our community banks. Now, how did that happen? Because the government picked winners and losers with these bailouts of these different banks. And so, the bailout has not answered any questions. You tell me what Bear Stearns bailout and AIG bailout helped. You tell me one small business guy or one individual that it helped. It didn't. It helped foreign investors. It helped other subsidiaries of these companies go away 100%. And so, I don't really understand what good we think this Title II is doing, and also Title I. And so I am just glad that the chairman has brought this bill up, and hopefully we will continue to bring portions of this bill up, if not the whole bill with Dodd-Frank, to try to repeal it. Maybe as many times as we've done the Affordable Care Act. But at the same time, this legislation has done nothing to make our economic situation better. It has done nothing to alleviate the problems that we're going to have. And as the ranking member mentioned this morning, those 5 companies that the government said or somebody said they couldn't go through bankruptcy. Why? Why? And so when you do bad deals, you do bad investments, you're responsible for it. And I believe that the government just needs to get out of the business and let the free market work. And with that, I yield back.
Time of the gentleman has expired. Is there further debate on the amendment? For what purpose does the gentleman from Colorado seek recognition? I'm sorry, does the gentleman from Texas seek recognition on the amendment?
I do.
Okay, gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I think that there is some confusion as to what too big to fail means. It means that a company should not, in failing, have an adverse impact on the American economy such that it can possibly take the economy down with it. If bankruptcy had been an appropriate tool for AIG, AIG could have gone through bankruptcy, but there was a problem. Who knew that AIG was a part of the glue holding the economic order together? If AIG had gone through bankruptcy, the American economy would probably be in a lot worse shape than it is today. The Orderly Liquidation Authority provides a means by which we can wind down the next AIG. We had no way at the time AIG became the centerpiece of the crisis as we were dealing with it at that moment. We had no way to wind it down. There was no means by which we could take AIG down without taking down a significant portion of the economy. And as a result, we put in some billions of dollars. Nobody wanted to do that. I speak for, I think, most of my colleagues on both sides when I say we don't want to spend taxpayer dollars, put taxpayer dollars into these efforts. But we had a choice. We could do nothing and watch the American economy go down the tubes, literally. Or we could engage ourselves and find a way on short notice to wind down a systemically important institution, which is what AIG was at the time. And that's what we did. Nobody wanted to do it. Nobody wants to bail out the local power company. But if it impacts everybody in that area and you're going to lose your electricity, you put into it that which is necessary to preserve the neighborhood, not wanting to see the power company receive benefits, but it's the neighborhood you're protecting. We were protecting our neighbors when we sought to wind down AIG. So there's no desire to have companies become so big that they will impact the American economy adversely. I don't care to see that. But if it does happen, I think there is some degree of comfort in knowing that there is a means by which they can be eliminated if necessary. They can be separated when possible into smaller entities, but such that they don't take the American economy with them. And that's what this orderly liquidation authority does. Now, there was some mention of the Affordable Care Act. More than 50 times I have voted. Actually, I think more than 60, but I'll just go with 50, so I'll be absolutely safe. More than 50 times I've voted on this notion of repealing the Affordable Care Act, and there has not been a vote yet to replace it. Repeal, yes. Replace, not so sure about that. Don't know that it's ever going to take place. But what I find interesting here, and I do admire my colleague for being candid, is that there's no desire to replace. This is just to repeal. This is to go back to 2008. This is to go back to the inability to wind down a systemically important institution that will take the American economy with it. I find that unacceptable. I cannot support this. I don't believe my colleague has any ill intent. I happen to like him very much, but I don't like this piece of legislation. So I will oppose it because I understand the necessity to be able to wind down the next AIG. I yield back.
Gentleman yields back. For what purpose does the gentleman from Colorado seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to thank my colleague from Georgia, Mr. Westmoreland, for his legislation and urge our colleagues to reject the amendment put forward by the gentlelady from Wisconsin. Mr. Westmoreland's H.R. 4894 will repeal Title II of the Dodd-Frank Act, thereby removing the federal government from having a role in liquidating a failing firm. Despite the promise that the Dodd-Frank Act will put an end to the era of too big to fail, the orderly liquidation authority found in Title II actually entrenches it. A bailout is implied merely by emplacing the too big to fail label on financial institutions, which is great for their creditors and for the counterparties, but leaves the American taxpayer shortchanged. Unfortunately, the FDIC's ability to access the orderly liquidation fund to provide operating funds for a firm that they deem risky to the stability of the financial system puts a burden of failure on taxpayers. Promoting a system of bailouts for failing firms and incentivizing moral hazard is not in the best interest of the taxpayers in my district or any other district across the United States, and was precisely the problem that the Dodd-Frank was supposed to fix. Not only does Dodd-Frank reinforce too big to fail, but it comes at the expense of our community financial institutions. While these small banks and credit unions, which are not capable of handling the onslaught of burdensome regulations from Dodd-Frank, are failing an average of 1 per day, the federal regulators continue their relentless pursuit of expanding the supervisory dragnet. Dodd-Frank has not delivered on its promises. Too big to fail is alive and well, and too small to succeed is the new normal for our community financial institutions in this country. For this reason, I'm happy to be able to support this legislation, encourage my colleagues to support it. This is a common sense measure, and to reject once again the amendment that has been put forward in the nature of a substitute. With that, Mr. Chairman, I yield back.
Would you yield to the chairman?
I will yield to the chairman.
I thank the gentleman for yielding. Again, I don't think the issue could be more stark or more well-defined. What should be the fate of troubled, large financial institutions? Those on our side of the aisle say they should go through a bankruptcy process. And in fact, this House just voted on such a bill last night. That, last I looked, enjoyed broad bipartisan support because it passed on a voice vote. Others, though, say no. We have to have some kind of bailout mechanism. Federal taxpayers ultimately have to be on the hook. That's exactly what has made the big banks bigger and the small banks fewer, is the whole idea that certain financial institutions ought to be too big to fail, and as the gentleman from Colorado pointed out, and others, are too small to matter. I don't think this issue could be more stark. And it was brought up by the ranking member, the idea of living wills. I think that living wills are probably a good idea. I just wish I knew what was in them. I don't know what's in them. The banks don't really know what their plan is supposed to be. The GAO just released a report. Quote, regulators have not disclosed their framework for determining whether a plan is not credible. They also developed but have not disclosed their criteria for reducing plan requirements for many smaller companies. Without greater transparency, the lack of clear understanding of the regulators' decisions may weaken public and market confidence in resolution planning and limit the extent to which the regulators can be held accountable for their decisions. That's what the GAO says. So now we have regulators coming out and saying, well, we find some living wills deficient. How would we know? How would any American know? Because there is no transparency, no accountability. They ought to be out there in the public domain so the investing public can make these judgments, so that the risk can be adequately priced, so that we can actually reduce systemic risk, so that banks can be right-sized, not supersized, not downsized, but right-sized according to market discipline and the free enterprise system, which has made us the freest and most prosperous people on the planet. So the mere fact that regulators come out from some kind of star chamber process behind a closed curtain and say, you know what, we find some plan to be deficient, again, how would we know? How would any American know whatsoever? I would also point out that Lehman went through a bankruptcy. And by bankruptcy standards, it appeared to work. I don't believe that AIG should have gone through a bankruptcy. The fact that people would stand for making sure that foreign banks get paid 100 cents on the dollar, which is exactly what this title does, should be objectionable to all American people. I thank the gentleman for yielding who seeks recognition. For what purpose does the gentleman from Washington seek recognition?
Thank you, Mr. Chair. I ask unanimous consent to submit to the record a joint press release from the Board of Governors of the Federal Reserve System in opposition to this legislation, as well as letters from Public Citizen and Americans for Financial Reform.
Without objection.
Thank you, sir.
Is there any further debate on the amendment? If not, the question now occurs on the amendment offered by the gentlelady from Wisconsin. All those in favor shall signify by saying aye. All those opposed shall signify by saying nay. Nay, in the opinion of the chair, the nays appear to have it. The nays have it. The amendment is not adopted. Is there any further discussion on the underlying bill? There being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it. For what purposes, gentlemen from Texas seek recognition?
Recorded vote.
A recorded vote has been requested. All those in favor of a recorded vote shall raise their hands and be counted. A sufficient number having raised their hands, a recorded vote is so ordered. And pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. The committee will soon recess, and we will vote on the two pending bills immediately after floor votes this afternoon. The committee stands in recess. Of pending matters, I now call up H.R. 1486. Committee come to order. The gentlelady from New York is in a special hurry. Now call up H.R. 1486. The clerk will designate the bill by title.
H.R. 1486 to amend the Consumer Financial Protection Act of 2010 to bring the Bureau of Consumer Financial Protection into the regular appropriations process and for other purposes.
An amendment in the nature of a substitute offered by the gentleman from Kentucky, Mr. Barr, was adopted by voice vote. The question is now in reporting the bill, H.R. 1486, as amended, favorably to the House. The clerk will call the roll.
Mr. McHenry. Mr. King. Mr. King, aye. Mr. Royce. Mr. Lucas. Mr. Lucas, aye. Mr. Garrett. Mr. Garrett, aye. Mr. Nagelbauer. Mr. Nagelbauer, aye. Mr. Pierce. Mr. Pierce, aye. Mr. Posey. Mr. Posey, aye. Mr. Fitzpatrick. Mr. Fitzpatrick, aye. Mr. Westmoreland. Mr. Westmoreland, aye. Mr. Lukemeyer. Mr. Lukemeyer, aye. Mr. Huizenga. Mr. Huizenga, aye. Mr. Duffy.
Aye.
Mr. Duffy, aye. Mr. Hurt. Mr. Hurt, aye. Mr. Stivers. Mr. Stivers, aye. Mr. Fincher. Mr. Fincher, aye. Mr. Stutzman. Mr. Mulvaney. Mr. Mulvaney, aye. Mr. Hulkren. Mr. Hulkren, aye. Mr. Ross. Mr. Ross, aye. Mr. Pittenger. Mr. Pittenger, aye. Mrs. Wagner. Mrs. Wagner, aye. Mr. Barr. Mr. Rothfuss. Mr. Rothfuss, aye. Mr. Messer. Mr. Messer, aye. Mr. Schweikert. Mr. Schweikert, aye. Mr. Ginta. Mr. Ginta, aye. Mr. Tipton. Mr. Tipton, aye. Mr. Williams. Mr. Williams, aye. Mr. Poliquin. Mr. Poliquin, aye. Mrs. Love. Mrs. Love, aye. Mr. Hill. Mr. Hill, aye. Mr. Emmer. Mr. Emmer, aye. Ms. Waters. Ms. Waters, no. Mrs. Maloney. Mrs. Maloney, no. Ms. Vasquez. Ms. Vasquez, no. Mr. Sherman. Mr. Meeks. Mr. Meeks, no. Mr. Capuano. Mr. Hinojosa. Mr. Hinojosa, no. Mr. Clay. Mr. Clay, no. Mr. Lynch. Mr. Lynch, no. Mr. Scott. Mr. Scott, no. Mr. Green. Mr. Green, no. Mr. Cleaver. Mr. Cleaver, no. Ms. Moore. Mr. Ellison. Mr. Ellison, no. Mr. Perlmutter. Mr. Perlmutter, no. Mr. Himes. Mr. Himes, no. Mr. Carney. Mr. Carney, no. Ms. Sewell. Ms. Sewell, no. Mr. Foster. Mr. Kildee. Mr. Kildee, no. Mr. Murphy. Mr. Murphy, no. Mr. Delaney. Mr. Delaney, no. Ms. Cinema. Mrs. Beatty. Mr. Heck. Mr. Heck, no. Mr. Vargas. Mr. Vargas, no. Mr. Chairman.
Aye.
Chairman, aye.
Is there any member who has not voted? The gentleman from North Carolina.
Mr. McHenry. Aye. Mr. McHenry, aye.
Gentleman from Kentucky.
Mr. Stutzman.
Gentleman from
Stutzman,
Kentucky.
Aye, I'm sorry. Mr. Barr. Mr. Barr, aye.
Gentleman from Indiana.
Mr. Stutzman. Mr. Stutzman, aye.
Is there any other member who has not voted? Is there any member who wishes to change his or her vote? If not, the clerk will report.
Mr. Chairman, the ayes are 33 and the nays are 20.
The majority having voted in favor of the bill as amended, the bill as amended is ordered favorably reported to the House without objection. A motion to reconsider is laid on the table. Staff are authorized to make technical or conforming changes, and members will have 2 days to file views on the reported measure. I now call up H.R. 4894. The clerk will designate the bill by title.
H.R. 4894 to repeal Title II of the Dodd-Frank Wall Street Reform and Consumer Protection Act.
The question is now on reporting the bill, H.R. 4894, favorably to the House. The clerk will call the roll.
Mr. McHenry. Aye. Mr. McHenry, aye. Mr. King. Mr. King, aye. Ms. Royce. Mr. Lucas. Aye. Mr. Lucas, aye. Mr. Garrett. Mr. Garrett, aye. Mr. Nagelbauer. Mr. Nagelbauer, aye. And Mr. Pierce. Mr. Pierce, aye. Mr. Posey. Mr. Posey, aye. Mr. Fitzpatrick. Mr. Fitzpatrick, aye. Mr. Westmoreland. Mr. Westmoreland, aye. Mr. Lukemeyer. Mr. Lukemeyer, aye. Mr. Huizenga. Mr. Huizenga, aye. Mr. Duffy. Mr. Duffy, aye. Mr. Hurt. Mr. Hurt, aye. Mr. Stivers. Mr. Stivers, aye. Mr. Fincher. Mr. Fincher, aye. Mr. Stutzman. Mr. Stutzman, aye. Mr. Mulvaney. Mr. Mulvaney, aye. Mr. Hulkren. Mr. Hulkren, aye. Mr. Ross. Mr. Ross, aye. Mr. Pittenger. Mr. Pittenger, aye. Mrs. Wagner. Mrs. Wagner, aye. Mr. Barr. Mr. Barr, aye. Mr. Rothfuss. Mr. Rothfuss, aye. Mr. Messer. Mr. Messer, aye. Mr. Schweikert. Mr. Schweikert, aye. Mr. Ginta. Mr. Ginta, aye. Mr. Tipton. Mr. Tipton, aye. Mr. Williams. Mr. Williams, aye. Mr. Poliquin. Mr. Poliquin, aye. Mrs. Love. Mrs. Love, aye. Mr. Hill. Mr. Hill, aye. Mr. Emmer. Mr. Emmer, aye. Ms. Waters. Ms. Waters, no. Mrs. Maloney. Mrs. Maloney, no. Ms. Vasquez. Ms. Vasquez, no. Mr. Sherman. Mr. Meeks. Mr. Meeks, no. Mr. Capuano. Mr. Hinojosa. Mr. Hinojosa, no. Mr. Clay. Mr. Clay, no. Mr. Lynch. Mr. Lynch, no. Mr. Scott. Mr. Scott, no. Mr. Green. Mr. Green, no. Mr. Cleaver. Mr. Cleaver, no. Ms. Moore. Mr. Ellison. Mr. Ellison, no. Mr. Perlmutter. Mr. Perlmutter, no. Mr. Himes. Mr. Himes, no. Mr. Carney. Mr. Carney, no. Ms. Sewell. Ms. Sewell, no. Mr. Foster. Mr. Foster, no. Mr. Kildee. Mr. Kildee, no. Mr. Murphy. Mr. Murphy, no. Mr. Delaney. Mr. Delaney, no. Ms. Cinema. Ms. Cinema, no. Mrs. Beatty. Mr. Heck. Mr. Heck, no. Mr. Vargas. Mr. Vargas, no. Mr. Chairman.
Aye.
Chairman, aye.
Is there any member who has not voted? Gentleman from California?
Mr. Royce. Mr. Royce, aye.
Is there any other member who has not voted? Is there any member who wishes to change his or her vote? If not, the clerk will report.
Mr. Chairman, the ayes are 34 and the nays are 22.
A majority having voted in favor of the bill is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. Staff are authorized to make technical or conforming changes. Members will have 2 days to file views on the reported measure. There being no further business pending before the committee stands adjourned.